Most buyers compare new build and resale property as if they are fundamentally the same asset. In the Algarve's golden triangle, they are not. Because one of the most important variables is not location, it's timing. A newly launched development and a renovated resale villa can trade at similar prices today, while behaving completely differently over the next 10 years. Different liquidity, different pricing power, different downside protection. Because they are not priced on the same timeline. One is forward priced, the other is history priced. And over time, that creates fundamentally different outcomes for buyers. The Golden Triangle is one of the few property markets in Europe where property behaves less like housing and more like capital structure. New build property operates on a forward pricing model. You are not simply buying completed value, you are buying future assumptions. Future demand, future scarcity, construction execution, developer positioning, and projected market sentiment. Pricing is therefore anchored to what the asset is expected to become, not simply what exists today. And in this market, that creates a very specific dynamic. Once a development establishes demand and supply becomes constrained, pricing rigidity increases quickly. Negotiation space compresses, inventory disappears. And buyers entering later phases often pay materially different prices for essentially the same product. In some projects, near identical units can trade 20 to 30% higher once supply tightens and market confidence is established. But in exchange, buyers gain something important: control, specification certainty, modern infrastructure, energy efficiency, lower near-term execution risk, reduced renovation uncertainty. So the trade-off is not price versus quality. It is certainty versus entry premium. Resale property operates on almost the opposite logic. It is history-priced inventory. Its value is shaped by acquisition timing, maintenance quality, architectural relevance, renovation standard, and alignment with current buyer expectations. This creates pricing dispersion. Two properties on the same street can perform very differently depending on positioning and capital input. One may simply reflect dated design. The other may contain unrealized architectural or planning potential. And unlike new build assets, resale properties can often be repositioned. Not through time, but through execution, through layout optimization, design improvement, privacy enhancement, outdoor integration, and architectural modernization. Which means part of the value is still unrealized at the point of purchase. And that is often where sophisticated buyers focus. This is also why price per square meter analysis can be misleading in the Golden Triangle. Because two properties with similar pricing may sit inside completely different market structures. One offers controlled condition and compressed uncertainty. The other offers pricing inefficiency and execution upside. They are not equivalent forms of value. They simply serve different objectives. Supply behaves differently as well. New build inventory in the Golden Triangle is structurally constrained. Land availability is limited. Planning is restrictive. Development cycles are slow. Which means many projects enter the market almost as scarcity events. Resale inventory behaves differently. It is continuous, always rotating, always repricing, and constantly influenced by owner behavior, market sentiment, and renovation cycles. This creates two entirely different forms of liquidity. New build liquidity is event-driven, resale liquidity is flow-driven. And that distinction matters far more than most buyers realize. Because liquidity ultimately shapes pricing resilience, exit flexibility, and long-term market behavior. So the real decision is not simply new build or resale. The real question is, what are you optimizing for? Specification certainty, ownership simplicity, long-term stability, passive hold quality, or pricing inefficiency, repositioning potential, strategic entry, execution upside. Neither model is inherently superior. They simply serve different strategies. And this is where many buyers misunderstand the golden triangle completely. They evaluate property categories when they should be evaluating market structure. Because in markets like Quinta do Lago, Vale do Lobo, Vilamoura, and Quinta, the primary drivers of long-term performance are often invisible to the casual buyer. Timing, scarcity, liquidity, buyer psychology. Those variables often matter far more than aesthetics alone. If you've missed the previous episode in the Market Structure Framework series, Framework number 1, I break down Vilamoura versus Quinta do Lago, liquidity versus scarcity. Two fundamentally different market systems operating side by side within the same region. And in the next episode of the Market Structure Framework series, Framework number 3, we'll move into another critical layer of the Algarve market. Rental-driven versus owner-weighted locations. Because markets behave very differently when demand is driven by yield generation, rather than long-term residential ownership. And understanding that distinction changes how sophisticated buyers evaluate risk entirely.